Another very useful restructuring tool in South Africa is Section 42 of the Income Tax Act, often referred to as an asset for share transaction. In simple terms, Section 42 allows a person to transfer an asset to a South African resident company in exchange for equity shares in that company, without triggering the normal immediate tax consequences that would usually arise on a disposal. The relief is not a tax exemption, it's merely a deferral. The company effectively steps into the shoes of the transferor, and the built-in tax cost moves with the asset or the shares until there's a later taxable disposal. In broad terms, the structure only works if the legal and tax requirements are met, including that the transferor receives equity shares and holds a meaningful qualifying interest in the company after the transaction. The opportunities created by Section 42 can be significant. It's often used when individual, trust, or another entity wants to move property, investments, or even a business operation into a company as part of a broader restructuring. The reasons may include asset protection, succession planning, bringing in investors, preparing for growth, or separating operating risk from long-term asset ownership. The benefit is that one can often restructure without an immediate capital gains tax hit, which helps preserve cash flow and makes a transaction commercially possible. It can also create a cleaner corporate structure for future share issues, family succession, or group reorganizations. But it needs to be done carefully, because Section 42 has detailed requirements and anti-avoidance rules, and in some cases, other taxes such as VAT and transfer duty may still need to be considered separately. Transactions that meet the specific requirements of an asset for share transaction are generally granted relief from transfer duty, but the purpose of this relief is to facilitate corporate restructuring without triggering immediate tax or duty liabilities. A good example is you transfer property into a new company. Now the new company owns the property. You own 100% of the company shares. Section 42 defers the immediate CGT, capital gains tax, that would usually have arisen. After the Section 42 transaction is completed, you can then gradually transfer some shares to children or a trust over time. Section 42 requires at the end of the transaction, you hold a qualifying interest in the company. Qualifying interest being at least 10% of the equity and at least 10% of the voting rights. So instead of transferring the property itself each time between generations, the company will remain the legal owner. Shares are easier to divide compared to dividing property, and new family members can then also be brought on board gradually, and estate planning can become simpler. So rather have a company owning the asset than individuals owning, and every time someone passes or changes, you have to move it. But it is very important that the proposed transaction be properly assessed before implemented. Transfer duty, existing bond arrangements, future income tax consequences, estate planning goals, and anti-avoidance rules and provisions can all affect whether the structure actually produces a net benefit. And a structure that works for a large portfolio of properties won't necessarily be suited for a single property. One size does not fit all.